Hey folks, how you doing today? It's Monday, March the 30th. We're just about in April here. Wow, passed so fast. And no trades today, just a couple of scalps in my paper trading account, but generally I'm spending the majority part of the day here just working on fine-tuning my setup and my indicators and everything to make sure everything works nice and smoothly for when I get back to live trading. I've been playing with a couple of indicators, but generally I'm trying to keep my charts as clean as possible. I don't want to be having to look at a lot of stuff while trading because simplicity is key, absolutely. But I have been playing with using the advanced decline indicators here. So take a look at this. I'll bring it up on my other chart. This is what I have going on my upper monitor here, and I'll just full screen it so you can see. So this is my broad market information. So whatever, I'm blocking the right side here, but this is the financial sector, XLF, the SPY, Qs, and I'm looking at the advanced decline volume, okay? Now I was playing with a few of these indicators and TradingView has many of them. So basically what this indicator is here, it says US stocks advancing volume versus declining volume. So this will go up if there's more up volume than down volume in the market, and it will go down if there's more down volume than up volume in the market, okay? Now, you can see a lot of these different ones on TradingView. Go to ADV, type in ADVDEC, like that on TradingView, and you can see that there's a whole bunch of them here. Advanced decline for the NYSE, the NASDAQ, for US stocks, for Dow Jones stocks, and for the individual exchanges, Amex, ARCA, etc. Okay? So this is useful, and I'm trying to incorporate this into my trading because it's just a market breadth indicator. It's like a sentiment indicator. So yeah, so you can take a look at that, and they have them for the NASDAQ, US stocks, etc. Put it on US stocks. So this is advanced decline for US stocks. So this basically, if it's moving higher, it basically means that there's more green stocks than red stocks in the market. And if it's moving lower, it obviously means there's more red stocks than green stocks. So that's the advanced decline. But again, ADVDEC .us, that's going to be the one that has the volume in there. Probably need to zoom in a little bit, but you can see that right now there's more of an uptick volume as the market is in a 5-minute uptrend, okay? So I'm just looking at this to see if it has any correlation, to see if it's actually worthwhile in using. Again, I'm trying not to look at too many things while trading. I want to keep it nice and simple. But one thing to note is that if you are trading the broad market, if you're trading the E-minis or the spiders, you definitely need to keep an eye on what the tech sector and the financial sector is doing, because those are the two biggest holdings of the S&P. So that's it, guys. Other than that, I'll show you my layout in Trader Workstation. It looks something like this right now. Too big, but it's basically smaller than that. Anyway, so I've got a chart, a few tapes, and I've got my options here. So it's very easy to fill orders with this because I can just click on the contract that I've inputted and I can just put in the order right away, transmit the order, and that's pretty much it. So for scalping, it works well. The only problem is in a paper trading account, obviously you can't get the fills you want because paper trading account will not fill you within the spread a lot of the time, which is why it's hard to scalp. So if you're trying to scalp a couple of dollars per contract, it's not going to work very well in a paper trading account, which is unfortunate, but you can try to do it with stock instead. All right, guys, so other than that, I've been also paying attention to the VIX, and one thing about the options chain, and I'm going to log into my actual account now to show you. Basically, I'm going to be looking at option prices in volatility instead of in actual prices, and I'll show you why in a minute because it makes a lot of sense. Hey guys, so this is what I wanted to show you here. So in Trader Workstation, you can choose to show your option prices in volatility instead of in actual prices. And this actually makes more sense. And apparently professionals view option prices in volatility. It's very important to look at implied volatility in the market right now. Currently, the VIX is just under 60. And according to the rule of 16, which means you divide the VIX by 16, that will give you your implied daily intraday move. The VIX is actually implying a 3.75 intraday move for the S&P. So we have to understand that this is important to be aware of when you're looking at, if you're trading the S&P, you understand that the VIX is implying that move. So the options market is pricing in approximately a 3.75 to 4% move. Okay. So when you choose option contracts to trade, you can use that info to fine-tune your trading strategy as to if you're going to be a net seller or a net buyer of options. So basically, if you think that the market is implying more than the option is going to move, then you probably want to sell the option. And if you think that the market is implying less than you think the option is going to move, then you probably should be a buyer of the option. So let's say it's implying, so implied volatility on these 0 days to expiry options here is 3.8%. So what that means is that these spider options expiring today, the at the money options are implying a 3.8% move in the stock price from the current price right now until expiry. So if you don't agree with that, if you think that SPY is going to move less than 3.8% from the current market price, then you should probably be a net seller of options. And if you think that the spider is going to move more than 3.8% from the current market price, then you should probably be a buyer of those options, right? So you want to trade with volatility on your side. That's the whole point of trading options. And nobody knows this. The majority of options traders do not know this. They think that you can just buy a call, the stock goes up and you profit. But actually you need to be aware of volatility, because sometimes the market is implying a certain move, but if you actually look at what the price action is suggesting, that move might not be as likely as the market thinks. So this is what I'm trying to incorporate into my thinking process when choosing trading strategies right now, guys. So right now in the spiders, 0 days to expiry, you can see it's 3.8%. That's what it's implying, okay? So if we go 1 day more, you can see that there's a bit more volatility on those options. 2 days to expiry, it's 4.1% here. So I'm viewing these option prices in terms of IV right now. So the at the monies are implying a 4% move. So if you sell this option, you're going to be net short volatility, okay? If you buy that option, ideally you want the market to move by 4% or more in order for you to make a decent profit. And it's not to say that you could, for example, let's say you're just scalping the markets. Obviously this applies less, but it's still important to trade with volatility on your side. All right, guys, so I'm still fine tuning my ideas here. I wish you a great week, and we'll keep in touch. All right, take care.